Welcome back to Financial Wellness Planning. My name is Derek Coffey, and I'm the founder of FWP. And if you've ever had a credit card or you've ever borrowed money from a lending institution, then you most likely have a credit score. The whole point of that score is to let lenders know how likely it is that you'll pay back the money that they lent you. Unfortunately, life's biggest purchases are probably going to require you to borrow money. And as much as the financial gurus want you to pay cash for a good used vehicle, it's almost impossible in today's times. But with a good credit score, you put yourself in a position to be able to borrow money when the time comes. In this video, we're going to get into the specifics of your credit score and how it's calculated. And we're also going to go over ways that you can improve it. That way you can have the highest score that you possibly can. Stay tuned. So you may be wondering why credit scores exist in the first place. Well, the whole point of a credit score is to give the lending institution an opportunity to determine how risky you'll be as a borrower. The higher your score, the less risk you present. The lower your score, the more risk you present. And your credit score also plays a major factor in one, determining if you're even eligible for the loan, and two, how much interest you're going to pay to borrow that money. The higher your credit score, the lower the interest rate you're going to have to pay. The reason this is because the interest rate that you pay is a compensation to the lending institution for lending you money. If you're perceived as a very low risk borrower, then they're not going to charge you as much interest to compensate them for that risk. If you have a very low credit score, then they're going to charge you more interest because there's a higher likelihood that you're not going to pay them back. So the higher your credit score is, the lower your borrowing costs are. And this is just one of the many benefits to having a good credit score. The way credit scores are broken down are into 5 categories. You have excellent, very good, good, fair, and poor. And depending on what your credit score is, that's what category you're going to fall into. But what we really want to get into is how that credit score is determined. Your credit score is calculated based on 5 factors: your payment history, the amount that you have outstanding or the amount that you owe, the length of your credit history, the new accounts that you're opening, and the types of credit that you use. The most important of these 5 is your payment history because it accounts for 35% of your overall score. And what they're looking for is that you make the minimum payments and you make them on time. If you don't have a handle on your money, you're most likely going to miss a payment or you're not going to be able to pay the full amount. If that's the case, then your credit score is going to suffer. Ensuring that you have that handle on your money and you know where your money is going is what's going to help you make those payments when they need to be made, and it's going to keep this portion of your credit score high. The second factor is going to be the amount that you owe or the amount of debt that you have outstanding. And there are 2 ratios that matter when it comes to this portion of your credit score. The first one's going to be your debt to income ratio. And what this is a comparison of all of your minimum debt payments to the amount of gross income that you bring in each and every month. To figure out what your debt to income ratio is, you're going to add up all of those minimum debt payments, you're going to divide it by the gross income that you receive for the month, and you're going to multiply it by 100%. Once you do that, that percentage is your debt to income ratio. Anything 35 and less is considered good. Anything from 36 to 49% is considered fair, and then anything over 50% is going to be considered poor. The second ratio we're going to go over is your credit utilization ratio. And what this does is it compares the amount of revolving debt that you have outstanding versus the amount of revolving debt that's available to you. And by revolving debt, we're talking about credit cards. And what they're looking for with this ratio is how responsible are you with your credit card debt? If you have $10,000 of debt available to you and you're only using $2,500, then your credit utilization ratio is 25%. Because you're only using a quarter of the credit that's available to you, then that's considered responsible. Now, if you had the same $10,000 available to you, but you had run up a $6,000 tab throughout all of the cards that you have, then your utilization ratio is 60%. If a lender sees this, they're not going to view that too favorably. So when it comes to your credit utilization, make sure you keep it at 30% or less. It's just going to keep you in the good graces of the lenders. The third factor that goes into calculating your credit score is the length of your credit history. Now, if you're younger, this is a little bit out of your control because there are only so many years that they can look back on. But what they're looking for is the average age of the accounts that are on your credit report. The longer that history, the more likely it is that it's going to help benefit your score. So, to help keep this portion of your score up, even though it's only 15%, is to keep old accounts open for as long as you possibly can, even if you paid it off. Cut up the card, throw it away, but leave the account open because it's going to increase that average. Also, avoid opening new accounts. If you open a new account, then that's going to lower your average and it's going to negatively affect this portion of your score. And this leads us into factor number 4, your new accounts. If you're constantly opening new accounts, then it's going to impact your credit score in a couple of ways. The first of which is it's going to shorten the length of your credit history. It's going to lower the average age of the accounts that are on your report. The second way that it could affect your score is your credit utilization ratio. If you're opening new accounts and immediately putting balances on those accounts, then your credit utilization ratio is going to go up, which is going to negatively impact your score. For example, let's say you had the $2,500 of credit outstanding, but you had $10,000 of credit available to you. Your credit utilization ratio is 25%. But let's say that you move into a new house or you're renting a new apartment and you want to get new furniture. You go to the furniture store, you purchase $5,000 worth of furniture because you're going to furnish the whole house, and you put it all on the store credit card. Now your credit utilization ratio looks completely different. Before, you had $2,500 outstanding with $10,000 available to you. Now you have $7,500 outstanding with $15,000 available to you. Your credit utilization ratio doubled to 50%, which is going to negatively impact your score. So avoid opening new accounts as much as possible. Sure, you may come across a deal that's too good to be true. You open up a store credit card, you get 18 months of free financing, you plan to pay it all off, that's great. But by doing that and immediately loading that balance, you are going to negatively affect your credit score. The final piece of your credit score is the type of credit that's on your credit report. In the lending industry, loans are typically broken down into 3 categories. You have a mortgage, an installment loan, and then revolving credit. And each of these come with different levels of risk. With a mortgage, that loan typically is on a piece of property that appreciates in value over time. If the bank lends you money, you default on the loan, the bank can repossess the property and sell it to recoup some of that money. Because the asset typically goes up in value, then this is a lesser risk to the lender. With an installment loan, this is going to be something like an auto loan, where it's still on a piece of property, but it could be a depreciating asset. Because the value of that property is depreciating, it's a little bit more risky for the lender, and they're going to charge you a little bit higher interest rate. And then the final piece is your revolving credit, and this is going to be on things like a credit card. This is going to have the absolute highest interest rate that you're going to pay, and the reason this is because there's no property that backs that credit card. It's simply your word that you're going to make those payments. So depending on the type of credit that's on your credit report, it's going to affect what your overall score is. If you don't know what your credit score is or you haven't checked it recently, then you should. Each of the 3 credit bureaus allows you one free report each year. Experian, Equifax, TransUnion, go to their websites and request your free report. When you get the report, what you're going to look for are discrepancies. And if there is something wrong, you need to dispute it. Now, it may take 45 plus days for that dispute to get corrected, but you need to get it corrected as soon as possible. That way, when you go to a lending institution to borrow money, they have the information that they need. Also, if there's stuff on there that you weren't a part of and were never involved in, then you may have been a victim of identity theft. So make sure that you pull this report every single year to make sure that the information that's being reported is actually correct. So maybe you do know what your credit score is, but you just don't want to look at it because it's not where you want it to be. Well, here are 3 easy steps to help improve your credit score fairly quickly. Number 1, make your payments on time. This is 35% of your score, so get a budget, get a handle on your money, make those payments on time. Number 2, reduce the amount that you have outstanding. If you have a bunch of credit card debt, build a plan to get rid of it. Once you get that paid down, then that 30% of your credit score is going to go up. And then number 3, all of those accounts that you get paid off, don't close them. Leave them on your credit report. Cut the card up, throw it away, don't spend any more money, but keep those accounts on your credit report. This is going to help the average age of your accounts as well as your credit utilization ratio. If you took nothing else from this video, I want you to understand that good credit is going to create opportunities that bad credit cannot. When it comes to buying a house, if you have poor credit, you may still qualify for a loan, but the interest rate is going to be so high, as if it's not high enough already, that it's just not going to fit in your budget. And the same thing could be said about purchasing a new car. But if you make your payments on time, you keep your debt levels manageable, and you leave the old accounts open on your credit report for as long as you possibly can, then you can improve 80% of your credit score immediately. I want to thank you so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you know someone who has a terrible credit score and they've been trying to make it better, send this video to them. Maybe to help them understand that it's not as hard as it seems. But I thank you so much for tuning in. I'll talk to you soon.